2021 was another year of global turbulence, with the recovery from COVID-19 happening faster in some countries than others, a trend which has continued into 2022. This year, the terrible war in Ukraine has also resulted in macroeconomic and geopolitical uncertainty. We have not been directly impacted by the war, as we have no operations in Ukraine or Russia, and as our exposure to Russia is minimal. But we continue to monitor the broader implications for our markets. You will have seen from our strong first quarter results that the business is performing very well, showing great financial and operational progress that comes from all the work we have done in recent years to strengthen our foundations and sharpen our focus. We remain strongly liquid and robustly capitalized, which together with our confidence in the business outlook enables the board to recommend a final ordinary dividend of 9 cents per share, taking the total dividend to 12 cents. We have returned $2.6 billion of capital to shareholders in the last 3 years through a mix of dividends and share buybacks. This includes paying out the maximum amount authorized by the regulator in 2020 when the emerging pandemic resulted in a suspension of distributions. The board's position on capital returns remains unchanged, and we expect to increase the dividend as we execute our strategy and progress towards a 10% return on tangible equity. Any excess capital that is not needed to fund further business growth will be returned to shareholders, and we aim to return more than $5 billion over the next 3 years. Let me just turn briefly to strategy. In February, we announced 5 clear actions that will accelerate the execution of our refreshed strategic priorities set out at the start of 2021. We are encouraged by the early tangible progress we have made on each item, which you can see in our first quarter results published last week. And Bill will cover this in more detail shortly. And despite the war in Ukraine and the uncertain environment, we remain confident about delivering the targets we communicated in February. This includes our ambition to generate a return on tangible equity of 10% by 2024, if not earlier. Let me turn now to climate change. We are acutely aware of the impact we have on people and the environment, both through our own operations and, more importantly, through the financing choices that we make. As you may know, we have committed to reach net zero for our finance emissions by 2050. And we announced a roadmap to achieve this ambition in October last year, setting out 2030 targets for the oil and gas, power, and metals and mining sectors. Many of you provided feedback along with clients and NGOs, and we published a revised roadmap in March based on that feedback. This extends our coverage to additional sectors and confirms that we will end all legacy direct coal financing globally by 2032. Our approach is in line with scientific good practice and emphasizes the need for a just transition to net zero. This means that we have to achieve our climate objectives in a manner that is consistent with the development needs in our markets across Asia, Africa, and the Middle East. Switching off finance for high-emitting sectors immediately is not an option. We have an essential role to play in helping clients and markets transition to a low-carbon economy, and this is not something they can do overnight. With this in mind, our net zero approach commits to mobilize $300 billion in green and transition finance by the end of the decade. Today's vote on our net zero pathway is intended to provide a means through which we can engage and gather your views. The board and management believe that our proposed plan is in the best interests of the company, our shareholders, clients, and markets. I hope we can rely on your support. Shareholders also have the opportunity to vote on a requisitioned resolution on net zero from Market Forces and Friends Provident Foundation. We have engaged with these organizations, hope to continue to do so, and have taken on board their feedback in our revised pathway. However, the board does not consider that the requisitioned resolution is in the best interest of our company and requests that shareholders vote against it. Let me turn now to governance. Earlier this year, we announced the appointment of Shirish Apte and Robin Lauder as new independent non-executive directors. Shirish joins us today for his first AGM with the group. Welcome, Shirish. Shirish is an experienced banker with a deep understanding of financial services in our markets, having spent over 30 years with Citibank. He also brings considerable experience as a global non-executive director. Robin joins us in July, and she brings significant experience across investment and commercial banking after more than 25 years at JPMorgan Chase. Robin also has valuable non-executive experience across global markets. In addition, we have announced that Naguib Karash stepped down from the board at the end of April. Naguib has made an invaluable contribution to the group, and on behalf of the board, I would like to thank him for his commitment, insight, and dedication, including his role as deputy chairman and chair of the audit and board risk committees. This will also be Christine Hodgson's last AGM, as she intends to step down later this year. We will let you know once the date has been finalized, but for now, on behalf of the board, I would like to thank Christine for her very considerable contributions to the group as Senior Independent Director and Chair of our Remuneration Committee. Thank you, Christine. You will also notice that Amanda Mella has stepped down since our last AGM, and I would like to thank Amanda for her many contributions over the past 3 years. But also let me take you the opportunity to introduce to you Adrian de Souza, who's sitting here on the first row. Adrian will be appointed by the board as company secretary tomorrow. He joined yesterday, having previously been company secretary for Vivo Energy. Since Amanda left, Scott Corrigan has been our acting company secretary. And I wanted to thank Scott for holding the fort so well. Thank you, Scott. Now, before I hand over to Bill, let me conclude with some comments on the outlook. We have had a strong start of the year, and we remain well positioned despite a challenging external environment. We continue to help our clients navigate uncertainties, especially those caused by the war in Ukraine and COVID-19 in China. But despite these uncertainties, there are many opportunities for us as a business. Market expectations of rising interest rates have strengthened as central banks in major advanced economies are starting to tighten monetary policy to counter inflation. We expect higher interest rates to improve our profit margins. Importantly, many of our markets remain amongst the most dynamic economies in the world, and accelerated change continues to drive growth over the medium term whether it is in the digital space, trade, shifts in supply chains, or sustainable development. And we continue to invest in digital innovation, and we now have an exciting set of transformative opportunities and partnerships. The transformation of our business in recent years puts us in a much better position to convert the dynamism in our markets to dynamism in our business. And I'm confident that with a singular focus on the execution of our strategy, we will create long-term sustainable value. Before I close, I want to extend my thanks to all of my colleagues from the board, management team, and to you, our shareholders, for your loyalty and ongoing support. Thank you very much, and now I will give the floor to Bill.